Tax reliefs, they help reduce the tax bills. There are some tax reliefs for companies to help reduce their tax, which are group relief, loss carryback relief, and foreign tax credit. Group relief enable companies to deduct unutilized capital allowances or trade losses or donations of one company from the accessible income of another company in the same group. The qualifying conditions are the transferor and claimant of the loss items have to be Singapore incorporated companies, belongs to the same group of the companies, and maintain 75% shareholder thresholds, and have the same financial year end. As for the qualifying loss items, they are to be transferred or claimed in the following orders: current year unutilized capital allowances, current year unutilized trade losses, and current year unutilized donations. Please note that income subject to tax at the higher rate will be transferred first, followed by the amount subject to tax at the lower rate, subject to the adjustments specified under Sections 37B of Income Tax Act, if applicable. Next, loss carryback relief. Company may carry back unutilized capital allowances and trade losses arising in a year of assessment to reduce the amount of the tax payable in an immediately preceding YA. To help businesses with their cash flow, it was announced in Budget 2020 that the loss carryback relief will be enhanced for YA 2020 as follows. Businesses may elect to carry back unutilized capital allowances and trade losses for YA 2020 up to 3 YAs immediately preceding YA 2020, that is YA 2017, 2018, and 2019. Business may elect for the current or enhanced carryback relief based on an estimate of the current year unutilized capital allowances and trade losses for YA 2020. To continue providing support to businesses, it was announced in Budget 2021 that the enhanced carryback relief will be extended to YA 2021 as follows. Businesses may elect to carry back unutilized capital allowances and trade losses from YA 2021 up to 3 YAs immediately preceding YA 2021, that is YA 2018, 2019, and 2020. Businesses may elect for the current or enhanced carryback relief based on an estimate of the current year unutilized capital allowances and trade losses for YA 2021. The last relief, foreign tax credit. Companies may claim foreign tax credit, FTC, for tax paid in a foreign jurisdiction against the Singapore tax payable on the same income. There are different types of features, and let's go through them one by one as follows. Types of foreign tax credit. There are two ways that Singapore company may avoid double taxations. Firstly, double tax relief, DTR. A DTR is the relief provided for under an avoidance of double taxations agreement, DTA, to reduce double taxations in the form of a tax credit. It allows the Singapore tax residents to claim a credit for the amount of tax paid in the foreign jurisdiction against the Singapore tax that is payable on the same income. A DTR will be granted if the foreign tax was paid in accordance with the DTA provisions and is capped at the lower of the foreign tax rate and the Singapore tax that would have been payable on the same income. Please note, a company is a tax resident of Singapore if the control and management of its business is exercised in Singapore. Secondly, unilateral tax credit, UTC. Effective yield of assessment YA 2009, a UTC will be granted on all foreign source income received in Singapore by Singapore tax residents from jurisdictions that do not have DTA with Singapore. Conditions for claiming FTC. The company must satisfy all of the following conditions in order to claim FTC. The company is a tax resident in Singapore for the relevant basis year. Tax have been paid or is payable on the same income in the foreign jurisdiction, and the income is subject to tax in Singapore. Company in loss position. No FTC will be given to a company in a loss position. Companies with permanent establishments overseas. When the companies have a permanent establishment PE overseas, and the income is derived through that PE, the income will generally be taxed overseas. A FTC would be granted only if the income is also taxed in Singapore. Companies deriving passive income. Passive income, for example, interest, dividend, derived from outside Singapore will generally be taxed overseas in the year of receipt. Such income will be taxed in Singapore in the year of remittance. A FTC will be given when the income is taxed in Singapore.